Hi, I'm Tom Lydon, editor of ETF Trends here in Hollywood, Florida at the Inside ETF Conference, and I'm here with Joel Dickson, Kinniry from Vanguard. Gentlemen, great seeing you.
Thanks.
Being here.
Vanguard, trusted brand in the ETF space, some of the incredible growth last year, but you talk to thousands of advisors every year. 2016 feels a little different. What are you telling advisors to help them with the volatility in the market and keep their stomach somewhat calm? Joel?
Well, volatility unfortunately is actually normal and part of the markets, and I think sometimes we forget that. We're down a little bit at this point, about 10% year to date on the U.S. equity market, roughly, and we were up over 200% the last several years. So keeping that perspective and approach while trying to calm their clients is what we find ourselves doing a lot of, because in many ways we're conduits. We're hearing from their clients what their concerns are, and how do we help coach and demonstrate the value that we can have through them.
Well, you provide a lot of great content, and also the video clips that you guys send out, it's fantastic. But the amazing thing is the sheer volume of billions of dollars that come into the Vanguard ETFs, especially when areas of the markets have declined. Fran, is that coming from the active side of the market out there?
Yeah, when you look at cash flows over the last decade, there's been a natural drain on traditional active funds, mostly because of high cost.
Yeah.
And they've gone into passive products, low cost, and even now the active ETFs that may be labeled as smart beta, but clearly they're active ETFs, rules-based active, and they're lower cost. So we're seeing a migration from high cost traditional active into lower cost index and lower cost smart beta products.
Yeah. But now that advisors are taking more of the responsibility on themselves as opposed to hiring active managers, during times of volatility, it's feeling quite lonely. So what do you do to kind of help these advisors, not be as worried about this volatility, or in fact, should they take action, Joel?
Well, I think the principles that we always go back to is that a lot of the value add that an advisor and in a relationship can have is actually the non-investment aspects of the portfolio. It is the behavioral issues of dealing with your own sort of biases as an investor, and then what your clients may be coming to you with. It's about focusing on things like costs and taxes. And that's where ETFs have played a very large role, as Fran just mentioned, on the shift from higher cost to lower cost fees. And that's a measurable, controllable benefit for investors. And we see that type of value add continuing to be important regardless of the market environment and well into the future.
Yeah, at the end of the year, kind of a down year in general for the marketplace, but we saw a lot of active mutual funds still, because of redemptions, kick off big year-end capital gains along with their higher fees. So is that, Fran, just kind of more of that same messaging? Get back to the core, watch the cost, watch the tax efficiency.
Yeah, exactly. In memory of Glenn Fry of the Eagles, first single, take it easy.
Yeah.
We just did a blog about take it easy, control what you can control.
Yeah.
The last 8 years, 5 of the 8, January was down.
Okay.
So January has not been a predictor for the full year.
Yeah.
We don't know how 2016 is going to turn out, but take it easy, control what you can control, costs, taxes, investor behavior.
Great, excellent. I feel much better now. Thanks, gentlemen. As always, it's great to see you.
Thanks, Tom.
Thank you.